So according to Vanguard, rebalancing to retain your bond stock allocation ratio can increase your returns at a rate of up to 0.35% annually. And this helps to prevent you from taking on more risk than you set out to take, and also aims to prevent you from taking on too little risk. But so the question is, when do I rebalance? Now, I've heard 5, 6, 7%. Here's an article that says 5%. Here's one that says between 4 and 10%. But let's just say that 5% is your number. So if you're a super low risk investor, you would have about 28% in stocks and 72% in bonds if you follow the Ibbotson study, in which they determined that from 1970 to 2010, this was the lowest risk allocation. And just by chance, if you rebalanced at the peak of the stock market on February 19th, 2020, because remember, you don't just rebalance as the stock portion of your portfolio underperforms the bond portion, like what's happening right now. You also rebalance as stocks are outperforming bonds. You're locking in those gains and moving money to safety. And when stocks go down, you're taking advantage of when stocks basically go on sale. So again, just by chance, if you rebalanced at the peak of the stock market on February 19th, 2020, as of right now, your portfolio as a whole has deviated somewhere in the neighborhood of between 5 and 6%. So if 5% is your number, you probably rebalanced when the Dow was between 20 and 21,000. And if 6% is your number, you haven't even reached your strike price. But more than likely, you didn't happen to rebalance right at the peak of the stock market on February 19th of this year. Let's say you rebalanced a year ago on March 20th, 2019. In this case, and by the way, your portfolio only down 3.65%. Keep that in mind when annuity salesmen data mine by looking at 100% stocks starting on February 19th, 2020. But anyway, in this case, we've still hit that rebalance point right at about Dow 20,000. Again, that's assuming that 5% is your rebalance number. So there you go. By the way, if you're not disciplined enough to follow a rebalancing schedule or strategy because you get all emotional about it, then there's ETFs that will auto rebalance for you. They have slightly higher expense ratios, but it's all done for you. By the way, on a side note, as the stock market keeps going down, we're going to find out who has been running Ponzi schemes. I think it was Warren Buffett that I heard once using the phrase, "It isn't until the tide goes out that you find out who has been swimming naked." Also, all these guaranteed real estate investments that were touted as not tied to stock market risk, I think some of these investors are going to learn some hard lessons. And I mean, particularly when it comes time to getting their original principal back. We'll see what happens to real estate. The real estate ETF VNQ is tanking just like stocks are tanking. And private equity does not live in an alternate return universe.